Before you attempt any of the homework problems in Chapter 12, I want to take a minute or two and go over all of the ratios and all of the formulas. It's not necessarily important for you to memorize the formulas. It is important that you understand what they do. And let's talk about these one at a time. I'm going to start with the receivable turnover ratio. It takes net credit sales and it divides by the average accounts receivable. Net credit sales by average accounts receivable. And what that says is in any given year, about how many times does a company collect all of the money that it is owed and replace it with new ones. This leads directly to the receivable turnover ratio, which says how long is it going to take us. So we take the turnover ratio, divide that into 365 days, and that says roughly how long does it take us to collect our receivables. Now, we can apply those same techniques to inventory. The inventory turnover ratio takes the cost of goods sold and divides by the average inventory. Now, average inventory, average receivable, beginning plus end divided by 2. Once we've come up with the inventory turnover ratio, it answers the question, roughly, how many times per year does this company sell all of its inventory and replace it with new inventory? We use that ratio to determine how many days are in inventory. And again, we take the ratio and divide it into 365 days. Current ratio we talked about a lot in class, and that simply says for every dollar that comes through the door, how many bills do they have to pay with it? Or for every bill that comes through the door, how many dollars do they have to pay? Take the current liabilities and divide it into current assets, and that gives you the answer. For every dollar that comes through the door in bills, we have X dollars to pay that bill. The debt to equity ratio looks at how much of our total capital structure is financed by outsiders and insiders. In other words, of our total shareholder equity and liabilities, the bottom part of the balance sheet, how much of it is equity and how much more or less equity do we have to our liabilities. Gross profit ratio is just gross profit, sales minus cost of goods sold, divided by net sales. Return on assets takes net income, divides by average total assets. This is right from the balance sheet. And again, beginning assets plus ending assets divided by 2. With any of these, if it says average and you're not given 2 years worth, just go with the 1 year that you have. Profit margin, net income divided by net sales. For every dollar in sales, what percentage, for every dollar in income, how many sales did you have to make? Or put another way, for every sale you made, how much resulted in net income? Asset turnover, again, this looks at net sales and it looks at average total assets. Total assets in the balance sheet divided into net sales from the income statement. How many times do we turn over our total assets in a year? Return on equity looks at net income and divides it by average shareholder equity. And again, this is paid in capital. And you add those, all the paid in capital together, divide it into net income, gives you how many dollars are returned, how much income comes out for each dollar of shareholder equity. Times interest earned and the acid test are two of the a little more complex. There's more elements to it. Times interest earned takes net income, but you remember you add back the interest expense and tax expense. So this is net income before interest, before taxes. Sometimes called EBITDA, income before interest and taxes. You'll see that in your finance stuff, income before interest and taxes. And divided by interest expense. This says how many times can you pay the interest that you owe each year. And the acid test, you'll see this a lot. This looks at the quick assets, or the acid test assets. They mean the same thing. Cash, current investments, and accounts receivable. Does not include inventory, does not include prepaid. Okay, just the stuff you can turn into cash quick, and you divide it by current liabilities. And it says, really, for every dollar that comes in the door in bills, how many real live, honest to God dollars will you have to pay that bill?